What's up, world? This is Darian, your stock market coach. I just wanted to come on here and provide you all with a thorough explanation of the difference between an investment account and a bank account, and also the pros and cons of both. So, what is an investment account? An investment account is an account that you can utilize to invest in stocks and bonds. You use an investment account to grow your money. That's why people open investment accounts. The goal is to grow their money. So another good thing about an investment account is with most brokers, and what I mean by brokers is basically the company that you're opening the investment account with. It is a zero minimum to open. And what that means is you only need the money that you would necessarily use to buy stocks or bonds to open the account. So if you just want to open the account today and you don't put any money in it just yet, you can still open it. So you got brokers like TD Ameritrade, Robinhood, E-Trade, Vanguard, Fidelity that you can use to open an investment account. Another great thing about the investment account is a lot of people don't know that are kind of new to investing is you have access to leverage. What is leverage? Leverage can be utilized to further grow your money and also use that money to go towards other things. So what I mean by leverage when you open an investment account is you have access to a margin. What is margin? You might have heard it, you might have not heard of margin. The simplest way I can break down margin to you, that is a perk that you have when you open an investment account along with growing your money, is the margin is like an access to a line of credit. So let's say you've been buying stocks now for some months or maybe a year or so, and your account has reached a $2,000 value. And what that means is you bought $2,000 worth of stock over time, or you have $2,000 in cash plus some stocks. But all together, between what you brought and what you actually hold in cash in your investment account, it has reached a value of $2,000. Once you have access to, you have actually invested $2,000 or have $2,000 in general in your investment account, you can apply for margin. Margin basically is an access to a line of credit that can be utilized to buy more stock in the stock market, or also pull cash outside of the actual cash that you have that you put in your account. So let me give you an example. So your account has reached $2,000 between stocks you brought, and you have $100 in cash that you, along with your $2,000 account value, you have $100 that you haven't invested in stocks yet. You just got a raw $100. Since your account is at $2,000, the margin, if it's approved, your account is approved for margin, they'll match you basically for what is held in your account. So if you got $2,000 worth of account value, you might have access to a margin of $1,000. So what that means is outside of the $100 that you have in the stocks that you got, you can pull $1,000 to buy more stock, or you can pull that $1,000 to use for cash, just to have, like, if you need to take care of something and the money's not there anywhere else, you can utilize that margin. Another good thing about margin is it comes with lower interest rate than a credit card, and also it's no credit check. You have access to it. Now, you do have to pay this back because it is still other people's money. But like I said, the positive thing is you don't have to run a credit check, and the interest rate usually with margin is a little bit less than what it would be sometimes with a credit card. And that just depends. You can just look at the margin rates, and they'll be all there in fine print when you apply for margin access with your account. I wanted to let you know about margin because a lot of people don't understand how margin works. Now, margin is risky, of course, because you're using other people's money. But if you're financially sound and you're financially responsible, the margin can actually be something good for you. You can use it to buy more stocks and then later put the money back towards the margin that you borrowed. Or also you can pull cash out the margin too. Let's say if you need to take care of something real quick and you might not have any other accounts, you can pull the margin out of the investment account and still not affect your investments, and then later come back and pay it before the margin interest hits, which is usually a month afterwards. So that's one of the positive things. It comes with risk, of course, because it's other people's money. So you must know that this is just a simple breakdown of margin, but you must know that it comes with risk. But if you're financially sound, you can use that risk for leverage. And what I mean by leverage again is you can use it to benefit you to further grow your money. So it's all about strategy. Margin is not for everybody, but sometimes people that are financially sound and responsible, they may just have their money locked up in savings and checking account, and that money can be put into an investment, or some of their money can be put into an investment account, and they can still have more access to leverage, because in a checking and savings account, you don't have leverage. And what I mean by that is your $2,000 or your $3,000 is just that in a checking or savings. When you got an investment account, if you got a margin access, it's actually worth more. Basically, you have collateral. So I just want to explain that it comes with risk. I always say never borrow what you cannot pay back on margin. Never come and just take the money and be financially irresponsible. Use it for your benefit in a positive way. Use it just like credit cards. You credit cards are not bad at all. You have to use credit cards to your advantage. Some people, they use credit cards to fund real estate deals, etc. Use credit cards for your benefit, just like margin. Use margin for your benefit. It's risk if it comes now outside of using it for cash, to have to use it for whatever you may need to use it for. You can also, like I said, use margin to buy more stocks, but that comes with more risk too, because let's say if the stocks are losing value over time, you could end up losing money from just investing in stocks and also having to still pay back the margin that you borrow. So always just make sure that you're being financially responsible with whatever decision you make, and always have a strategy. Margin for some people is good. Margin for some people, it doesn't make sense. But I just wanted to let you all know that, because a lot of people don't understand margin. They have no idea that that's a perk with having an investment account, that you can actually have more leverage when it comes to growing your money. So down to the bank account. Like I said, the bank account, the positive things about a bank account is that you can use it, of course, to pay your bills, spend for leisure, and also build an emergency fund. Bottom line, you cannot grow your money in a checking and savings account. You have limited growth. That is one of the cons of a standard checking and savings account. You have limited growth versus an investment account. It comes with risk, but you have potential unlimited growth over time. It can continue to grow. You can continue to use the margin for leverage, or you could continue to buy stocks, and the stocks are good quality companies, so it's going to continue to grow. The growth is, it's no limit on it. Sometimes with an investment account versus a checking and savings, you're limited growth on interest rates and stuff like that. So the positive thing about a checking and savings is it's a little bit safer. That's about it. It's less riskier. But I look at it this way. You should use both for your advantage. You should use your checking and savings to build your emergency fund, meaning if something's happened with your car today, you got an emergency fund that you built up. You could pull that money without tapping into a credit card or tapping into your investment account. Have to sell any of your stocks or anything like that. You got that emergency fund built up. Also, your checking account to spend money if you got trips or whatnot, and also to pay your bills. That's the positive thing about it, is to keep your money safe. Checking or savings account. But if you want your money to grow, you have to put it towards risk. Investments come with risk, bottom line. But like I said, always tell everybody, without any risk, there's no reward, bottom line. So you just, at the end of the day, you have to know what is the benefit of both accounts. And me personally, I don't limit myself to either or accounts. I have both. I have my standard checking and savings account, and I also have my investment accounts. I know the purpose behind both. So I just wanted to give you all a overview on an investment account and a bank account. What's the difference, and what's the pros and cons, and what's the benefits? If you know anyone who needs this information, if you all can do me a favor, I'd greatly appreciate it. Share this video with someone that you know needs this information and that will definitely benefit from it. Like, comment, subscribe to my channel. I hope to continue to give you all more beneficial information that can empower you. And once again, this is Darren, your stock market coach.